Mortgage rates were at a historic low just a few months ago. But the Federal Reserve, they stepped in. They said that they were going to destroy demand, and they began to aggressively raise interest rates. As you would expect, mortgage rates have skyrocketed over the last 9 months. And now we sit with the highest mortgage rates that we've seen since the 2008 housing crisis. This has led to a significant cooldown in the amount of people who want to borrow capital to go and purchase homes. Interest rates have now closed in, hitting almost 6% for the U.S. mortgage market. But not all mortgage interest rates are created equally. As we can see here, Charlie Bolillo points out that the adjustable rate mortgage in the US has moved up to 4.6%, which is the highest since 2009. Just at the end of last year, it was down under 2.5%. And the 15-year mortgage rate in the US has risen to over 5%, which is the highest level since 2008. And just a year ago, it was down around 2%. Last but not least, the monthly mortgage payment on the median home for sale in the United States has increased 40% over the last year. It's now up over $2,300 as mortgage rates have moved from 2.88% to just under 6%. Now, of course, we should expect the Federal Reserve to have an impact in the market. They are intervening. They're trying to destroy demand. And a great way to destroy demand is to make capital more expensive. It's exactly what they've done. Inflation has not necessarily come down in the way that they would have expected, but we do know that they are successfully destroying that demand. What this leads to is a stagflationary period. It's quite scary. We right now have high inflation and we're in a recession with 2 consecutive quarters of negative GDP growth. The big question remains, can they continue to raise interest rates while we're in a recession? This is quite unprecedented times. Regardless of what happens to the overall economy or GDP growth, one thing to continue to watch, how high will the U.S. mortgage rates go as the Federal Reserve remains committed to raising the interest rate and the cost of capital? I don't know, but what I do know is that they already have an impact. If they continue to raise those interest rates and mortgage rates continue to spike, they're likely to lead to some sort of pain in the housing market. Nobody wants that. U.S. mortgage rates are now at a high that we haven't seen since 2008, 14 years ago. I hope that the Federal Reserve can get inflation under control, can return back to that loose monetary policy, and bring some normalization back to the market so that the average American family can not only buy a home, but they also have all sorts of freedom because they have extra cash flow that isn't being eroded away by inflation and also isn't being spent on all of these consumer products that continue to increase significantly in price. Hey you, did you like this video? Great, make sure you subscribe, like the video, and see you next time.